All right, let's talk about two of the most fascinating and frankly frustrating assets on the planet, gold and Bitcoin. But for this, we're going to throw out all the daily noise, all the charts, and build a totally new way of thinking about how these things actually work in the grand scheme of the economy. Let's dive in.
You know, this right here, this is the key that unlocks the whole puzzle. We've got to stop obsessing over the minute-by-minute price wiggles. Instead, we're going to put on a different set of glasses and look at these assets through the lens of massive global economic forces, because that's what really moves the needle.
So what we're doing here is building a new mental model. The goal isn't about trying to predict next week's price, not at all. It's about understanding the engine humming under the hood. We want to know what fundamental drivers make these assets soar and what makes them crash and burn over the long haul. Okay, so this slide gets right to the heart of it. This is our core idea. Gold, at its core, is all about real interest rates and trust, or lack thereof, in the traditional system. Bitcoin? It's a totally different animal. It feeds on liquidity. You know, the amount of cash sloshing around the global economy and how many people are adopting its network. Two very different identities.
I mean, think about it for a second. A stock can pay you a dividend. A bond pays you interest. But gold and Bitcoin, they don't generate any cash, so their value has to come from somewhere else, right? And it comes from these big macro forces, the real cost of holding cash, how much risk investors are willing to take, and maybe most importantly, the stories we all believe about them. That's the whole game right there.
All right, let's kick things off with the old guard, gold. For literally thousands of years, it's been the go-to store of value. But what does that actually mean in today's world? Let's pop the hood and see what makes it tick. Seriously, if you walk away with just one idea about gold, make it this one. This is its kryptonite, its superpower. When real interest rates are heading down, gold tends to do really, really well. But what on earth is a real rate?
So the real rate is pretty simple. It just tells you if your money's actually growing or if it's shrinking. Let's say inflation is at 5%, but your bank account is only paying you 2% interest. Well, your real rate is a negative 3%. You're literally losing purchasing power just by holding cash. And in that kind of world, an asset like gold, which can't be printed into oblivion, starts looking a whole lot more attractive.
So this basically gives us the recipe for a gold bull market. What do you need? You need real yields to be falling. It helps if the US dollar is getting weaker. It definitely loves when there's stress in the system, think banking panics. And you get a bonus when big central banks around the world start buying it up. That's the magic formula.
But of course, it's not always a party for gold investors. We all know it can spend years, sometimes a decade, just going absolutely nowhere. It can be incredibly boring. So what's going on then? What are the conditions that just crush gold's momentum?
Well, there are pretty much two big environments where gold really struggles. First, when central banks are jacking up interest rates to fight off inflation. All of a sudden, you can get a nice, safe return from a government bond. Why hold a rock that pays you nothing? And the second is when the economy is just humming along, stocks are screaming higher, and everybody's feeling greedy. In those risk-on times, gold just looks like boring, dead weight.
And that really brings us to the perfect way to think about it. Gold is portfolio insurance. You don't buy fire insurance for your house hoping it burns down. You have it just in case. And for long stretches, it feels like a useless expense. But when things go wrong, when that crisis hits, you're incredibly glad you have it.
Okay, let's totally shift gears now. We're moving from the ancient physical metal to the new digital kid on the block. And you have to understand, Bitcoin's macro engine is completely different from gold's. It runs on a totally different kind of fuel.
Bitcoin is what you'd call a high beta liquidity asset. Now, that sounds complicated, but the idea is simple. Think of global liquidity, all the money flowing through the financial system as the ocean tide. Bitcoin is like a cork on that ocean. When the tide of money comes in, that cork shoots up way faster than anything else. But when that tide goes out, it comes crashing down just as hard.
So here's the formula for Bitcoin. It's driven by more liquidity, a risk-on mood where investors feel brave, a ridiculous amount of leverage built up in its ecosystem, and of course, the underlying growth of the network itself. Just look at how different these drivers are compared to gold's. It's a whole different ballgame. And that brings us to the elephant in the room. The big, scary question. Why the heart-stopping 80% plus crashes? It's not just random panic. There is a structural, mechanical reason baked right into the Bitcoin market that makes these brutal drawdowns almost inevitable.
You see, the Bitcoin market exists inside what we can call a leverage machine.
During the good times, people borrow insane amounts of money to amplify their bets. This leverage acts like rocket fuel on the way up, creating those parabolic moves we see. But it also makes the entire structure incredibly fragile.
And this is how the machine breaks. It all starts with a little dip in the price. But that dip triggers automatic sell orders for all the people who borrowed money. We call those liquidations. Those forced sales add more selling pressure, which pushes the price down even further, which, you guessed it, triggers the next round of liquidations. It's a terrifying domino effect that just feeds on itself all the way down.
So, we've seen how they work, and we've seen how they break. Now let's get real and compare what it actually feels like to own these two things, through the good times and the bad.
This table just nails the psychological difference. The pain of holding gold is the pain of time. It's the slow, agonizing bleed. It's the years of boredom where you feel like a fool for missing out on everything else. The pain of holding Bitcoin is the pain of depth. It's that sudden, violent gut punch of a 75% crash that makes you question your sanity.
And because they hurt you in different ways, they also need different things to get better. Gold needs a fundamental shift in the whole macro picture, like the Fed announcing it's going to start cutting interest rates. Bitcoin, on the other hand, just needs the tide to turn. It needs liquidity to start flowing back in, for investors to get their courage back, and for its network to keep growing.
Okay, so this is all great, but what do we do with this information? The final step is to take off our gambler hat and put on our institutional investor hat. We need to think about building a portfolio that can last.
And this is the single most important question you can ask. Forget, is it going up or down? The real question is, what specific job am I hiring this asset to do for me? When you reframe it like that, it changes everything. You move from pure speculation to actual strategy.
And as we've seen, they have totally different job descriptions. You hire gold to play defense. It's your insurance policy against chaos. You hire Bitcoin to play offense. You're buying a small lottery ticket for a potentially massive, asymmetric payoff, and you accept the crazy volatility that comes with it.
And let's end with this piece of simple, powerful wisdom. Once you understand the pain profile of an asset, you can size your position correctly. If you know that Bitcoin can drop 80%, you make sure your position is small enough that you can sleep at night and not be forced to sell at the absolute bottom. At the end of the day, this macro model isn't about predicting the future, it's about preparing for it, and that's the real secret.